In 1949, Alfred Winslow Jones opened an office near Wall Street with $40,000 of his own money and $60,000 raised from friends. He charged no fee at all unless the fund made a profit. Later, he added a 2% charge on all assets under management, regardless of whether the fund gained or lost money that year. On the profits themselves, he took 20%, a figure he attributed to the custom of Phoenician sea captains, who kept a fifth of the proceeds from a successful voyage. In time, that structure, 2% of assets, 20% of gains, had a name: 2 and 20. By 1966, Fortune magazine profiled Jones under the headline, "The Jones Nobody Keeps Up With," and the arrangement he had built quietly became the template for an entire industry. The structure is usually explained as the price of genius, a toll paid for access to a manager who reads the market better than anyone else. What the toll buys is rarely described past that point. It is not one fee. It is two, stacked on different bases, measured against different clocks, sitting on top of a financing system built on borrowed securities and backed by contractual valves that decide, in a crisis, whether an investor is even allowed to leave. None of that machinery requires the manager to be skilled. All of it determines, before a single trade is placed, how much of any gain the investor keeps and how much of any loss the investor absorbs alone. The management fee is charged on committed capital, independent of outcome. It is owed whether the fund is up for the year or down. The incentive fee is charged only above what the industry calls a high water mark. A fund that loses money must first earn back the loss before any performance fee accrues again. That single asymmetry, a fixed fee regardless of result, a variable fee only on the upside, is the seed of the rest of the mechanism, and it was already fully formed within 20 years of the fund's founding. In the years that followed, the 2 and 20 template was copied widely enough that it stopped being one man's compensation arrangement and became an industry standard, applied by managers whose skill had never been measured against Jones's own record, and adopted without most investors examining what the two layers, compounded, actually produced. Underneath the fee sat a second layer of machinery, one most investors never saw directly: prime brokerage. A prime broker executes a hedge fund's trades, holds its assets in custody, lends it money against those assets as margin, and lends out securities on the fund's behalf. Running that business is expensive, and prime brokers offset the cost through a practice called rehypothecation, taking securities a fund has pledged as collateral and using those same securities for the broker's own business, selling them, lending them, or trading them to support its own balance sheet. In exchange, the fund typically receives cheaper financing than it could get elsewhere. In the United States, that reuse was capped under SEC Rule 15C3-3 at 140% of a client's debit balance. In the United Kingdom and Europe, no such cap existed. A client's pledged collateral could be reused without limit. On September 15, 2008, Lehman Brothers Holdings, Inc. filed for Chapter 11 protection in the Southern District of New York. Its London prime brokerage unit, Lehman Brothers International Europe, held roughly $32 billion in client assets. Within weeks, it was confirmed that a portion of those assets had been rehypothecated, reused inside the broker's own operations, and were no longer held for clients on a segregated basis. Investors who believed they held a proprietary claim to their own collateral instead found themselves classified as unsecured creditors, standing in line behind Lehman's other obligations. One of the funds caught in the freeze, a firm called Oak Group, Inc., had operated for 22 years before its prime brokerage relationship with Lehman's London desk left its assets locked inside the estate. The administrators eventually moved to return roughly $12 billion of the roughly $32 billion held at the time of the filing. A recovery, but one that took years and had nothing to do with whether any individual fund's strategy had performed well or badly. The mechanism that froze the assets was not the fund's investment decision. It was the financing arrangement sitting underneath it, and the jurisdiction in which that arrangement happened to be domiciled. The same crisis exposed a second valve, this one built directly into fund documents rather than into the broker relationship. A redemption gate limits the percentage of a fund's assets that can be withdrawn on any single redemption date, commonly 20 or 25% of the fund's value, with any request beyond that cap reduced pro rata across every investor seeking to leave at once. A side pocket goes further. It separates an illiquid holding into its own non-redeemable share class, so an investor cannot withdraw that portion of their capital until the position is actually sold, however long that takes. Both tools were presented as protection, for the fund and for the investors who chose to stay, against a run that would force the manager to sell illiquid positions at distressed prices to meet withdrawal requests. In October of 2008 alone, investors pulled $40 billion out of hedge funds industry-wide, according to hedge fund research, and dozens of funds responded by imposing gates. But the record shows the tool did not always work as intended. Rather than preventing panicked withdrawals, in some cases the mere threat of an approaching gate accelerated them. Investors rushed to submit redemption requests early, to secure a place in the queue before the gate could be triggered, close to the opposite of the calming effect the provision was designed to produce. Side pockets carried a second, quieter feature. Assets held inside one are typically not marked to market for annual incentive fee purposes. The fee on that portion is calculated only when the position is eventually liquidated. A tool built to protect against a forced sale also changes for that slice of the portfolio exactly when and how the manager gets paid on it. After 2010, Title IV of the Dodd-Frank Act required funds managing more than $150 million to report gate and suspension activity to the Securities and Exchange Commission on a confidential form. The requirement created a record. It did not change the terms of any fund's contract. None of this, the two layers of fees, the financing arrangement, the gates, required a manager to be either brilliant or fraudulent. The clearest demonstration of what the structure does on its own comes from a study of nearly 6,000 hedge funds operating between 1995 and 2016, published as a National Bureau of Economic Research working paper by Itzhak Ben-David, Justin Biru, and Andrea Rossi. The funds in the sample charged, on average, a nominal incentive fee of 19% of gross profits, close to the standard 20%. Over the full period, investors actually paid out 49.6% of their cumulative gross profits as incentive fees alone. Not 19%, just under half. The gap traces to how the fee is measured, not to any single manager's behavior. Consider two managers inside the same portfolio, both charging 2 and 20. If both post a 20% gross return in a given year, the investor keeps 11.7% net, with fees consuming 41.5% of the total gross return, already more than double the stated rate. Now, suppose one manager posts 20% and the other loses 5%. The two results are not netted against each other before fees are calculated. Each manager is paid on individual performance. The investor's net return falls to 2.25%, with 70% of the total gross return paid away in fees, even though the portfolio as a whole barely made money. The losing manager's losses do not offset the winning manager's fee. They simply disappear from the investor's side of the ledger. Across the full sample, this arithmetic produced $113.3 billion in performance fees paid on $228.2 billion in gross profits, roughly $70 billion more than a strict 19% rate would have produced. Extrapolated to the wider industry over the same 22 years, the residual came to an estimated $194 billion, money paid not for skill above the stated rate, but for the way the stated rate was applied. A separate longitudinal count from LCH Investments found the trend moving in one direction over time. Hedge fund fees represented roughly 30% of gross profits between 1969 and the early 2000s, and more than 50% since. The popular account asks whether a manager is skilled enough to justify the fee. The documentary record asks a different question: what the fee structure captures regardless of skill. A management fee owed whether the fund wins or loses. An incentive fee calculated per manager rather than on the blended result an investor actually experiences. A financing arrangement in which a client's own collateral becomes the broker's asset until the obligation is unwound. A gate that can accelerate the very run it was built to prevent. None of it appears on the one-page summary of what a fund charges. All of it is running, in some form, inside a fee statement being calculated this week, for an investor who was told the number was 20.